As we start out the month of January, we have a market condition relatively rare. It's primed to explode. How do we take advantage of that? Welcome to the 12-Minute Trading Market Minute for Monday, the 2nd of January. First off, let's talk about the technical signal that I'm seeing. This is the S&P 500, and what we're seeing is on the different time frames, we have monthly here on the left-hand side, weekly in the middle, and here's the daily time frame. And all three of these are in alignment and showing a massive amount of potential energy. So what we're seeing is very light trending over the last several months. Again, this is coiling up the spring and increasing the potential energy for the next move. We're seeing the same thing happening on the weekly chart. Several weeks trading in the same approximate range. This builds up a huge amount of potential energy. And then, of course, if we zoom in on the daily chart, we can see that this has been a very tight little volatility coil over the last several trading days. This is building up, again, a tremendous amount of potential energy. So it's like we're holding a wound spring in our hands, and it's getting tighter and tighter and more difficult to hold on to that. It's going to come flying out in one direction or another in the next few days. Now, let me state that I think it might break to the upside just because there's so many bearish people out there right now. It seems like everybody agrees that the market's heading for disaster in 2023. This is why I think there may be a chance that we actually see the opposite thing occur. But I don't presume to know what the future is. So what I want to do is I want to take advantage of any large movement. I don't care what direction it's in, and I'm going to do that through an option strategy. Now, the typical way that people are taught to handle a condition like this is through what's called a straddle. So the first thing we need to determine is the time element. How long do we think that this is going to happen? And it needs to be relatively accurate, because if we end up just saying, well, let's get sloppy here and we'll just buy as much time as we need, that's not going to necessarily provide us the solution that we want. Not only will it be expensive to add this, but also it's going to be very sluggish in terms of movement. So we do want to apply some element of timing to this. And I think that if we're going to get a move, it's going to happen in the next 2 to 3 weeks or so. We rarely get conditions like this where we continue to sit there and consolidate and coil within a very tight range once we reach those levels that I talked about on the chart. So if we go at something like the 20 January options, say that's maybe our timing for that. Let's look at adding a straddle on the SPX. So the first thing we'll do is we'll go right at the money, and we're going to right click here. We're going to analyze buying a straddle. And what we're going to notice is that for the 20 January straddle, that has got a debit of 153, which is 15,340. Now notice also this is very close to the expected move for this. This is why sometimes using a straddle is a way to generate an estimation of the expected move going forward. And what that expected move means is that it's a plus minus 1 standard deviation movement in price based on the current volatility. So plus and minus 1 standard deviation, the market's estimating that the price is going to be within an envelope of plus and minus 156 points or so into the 20th of January. Okay, so what does that mean for the strategy itself? Let's look at the risk profile of this. All right, so if we end up putting up in margin $15,000, which is the most that we could possibly lose from this trade if the price goes nowhere. So if we're sitting there on the 20th of January and the price is still around 38.40 on the S&Ps, we're looking at losing a bundle. And this is why we have to have an accurate read on the charts showing that there is a lot of potential for a movement one way or the other. So maybe you like the idea of this strategy, but 15 grand is a little bit too much to risk on a trade like this. What you can do then is you can go out to something like the spiders, which offer 1/10 the notional value of those options. We can go to the 20 January And I think what we're going to find here is that this is going to be about 1/10 the price. If we go out to a 384 straddle, that should be about $1,500. And there we go. It's about $15 debit, $15.28. If we look at the risk profile, we can see that the most that we would lose on this trade is about $1,500. Again, maybe that's a little bit more than you wanted to spend on a strategy like this, even though there's a nice payoff if there's a good move in either direction. What we can do now is we can cap our risk. I'm going to go back to the SPX and I'm going to put on a trade which is called an iron condor. So we're going to go to those same 20 January options. And what we're going to do is we're going to look for about a 25 delta, and you'll see why in just a second. So let's go out here and let's say we're going to set up a long put debit spread at 37.10, 37.15. So we're going to analyze buying an iron condor. We're going to set up those strikes to begin with, 37.10, 37.15. And then we're going to go up and adjust our call strikes for about the same deltas up here. And we're going to make those 39.75, 39.80. Okay, so I've adjusted my call strikes 39.75, 39.80. You can see that the debit here is about 245, and we want that to be right around 250. So that's pretty close. And what this looks like, we're going to have to zoom in on this, but what this creates is a limited risk trade, which has got the same idea. So the risk down here is about 250 max. That's the most that we could lose on this potential trade. And the reward up here is also about 250. So this is a 1-to-1 reward to risk trade. Now it's got the same idea. We need to see the price move in a pretty strong direction one way or another for us to win. And that's the signal that the chart is providing us that we're anticipating a big move. We don't know which way it's going to go. It's going to go in some direction. And we don't want to be in a position where we're yelling at the chart saying, wait, you're going the wrong way, because that means that we're wrong. So this is a very simple trade that we can set up and just let things unfold in whatever direction that the market is going to choose, irrespective of what we think should be happening. And that's the conundrum that I think a lot of retail traders find themselves in, is that market ends up moving in a direction that they don't think makes sense. Now let's circle back and go back to the chart, and we can see again that our break-even points are, let's say, roughly 37.10 down here and 39.75 up here. So here we are at the chart, and what I'm going to do is draw a little box here which represents the area that the price needs to go beyond for us to be profitable. So we said 37.10 to the downside, 39.75 to the upside. So really what we're talking about is, do we think that over the next 20 days, the price will be outside of this box? I do think so. This amount of consolidation, this amount of power to drive the next trend is pretty strong, especially when you look at the multiple time frames that we have here, where we have just a tremendous amount of potential energy. The market's really gone nowhere for the last several weeks. Range contraction like this leads to range expansion every single time. Welcome to the new year. It's going to be a good one. Thanks for listening, and we'll see you in the next Market Minute.